Today, Senator Collins and I are making public three draft legislative proposals which would, if enacted, dramatically reduce the speculation in commodities markets that we are convinced is a major cause of the skyrocketing cost of food and fuel. Right now, curbing such commodities market speculation may be the best and quickest way to ease the pain consumers are feeling when they buy gasoline or food or when they go to buy, soon, home heating oil. Our immediate objective in putting forward these draft proposals is to stimulate discussion. We're not introducing legislation today, but we hope that these proposals will stimulate comments, questions, and debate. Senator Collins and I have held two hearings in the Homeland Security and Governmental Affairs Committee to examine the impact of speculation in the commodities markets. We plan a third hearing for next Tuesday, June 24th, at which we will take testimony from the chairman of the Commodity Futures Trading Commission, Walt Lucan, and other witnesses on the specific draft proposals that we are unveiling today. Our plan is to introduce legislation after the July 4th recess and then to ask Congress to pass it this year. And we do that because we think that commodity market speculation is such an important factor in the run-up of food and fuel prices. At our last hearing, the chief economist at the CFTC sought to assure us that the financial speculators were not actually contributing to rising food and fuel prices, that basically speculation is good for the markets no matter how great that speculation is. But based on all the testimony presented and the comments received, I have concluded that speculation in the commodities markets is in fact excessive and is in fact contributing considerably to the run-up in food and fuel prices. The CFTC witness at our hearing conceded that the Commission does not have authority over all commodity trading that takes place, particularly not over the trading that occurs over the counter. And that's a serious shortcoming because recent increases in commodity speculation are most prominent in the over-the-counter markets. Consider this. From 1998 to 2008, the last decade, the share of so-called long interests in commodities held by financial speculators has grown from 1/4 of the market to 2/3 of the commodity market. Let me explain by way of definition that I'm calling financial speculators here those investors looking to commodity price appreciation or depreciation to generate financial returns. They now account for 2/3 of those long interests in commodities in the market. Bona fide hedgers are farmers, oil producers, and others who participate in the futures market for what it was originally created to do, which is to reduce their risk by locking in prices on next year's crops or oil production. These bona fide hedgers, or others call them physical traders because they're actually in the business that they're trading futures around. These bona fide hedgers or physical traders used to own 75% of the contracts on the commodities exchanges, the markets. Today, they're down to 1/3, and that's a dramatic drop. Let me add this number. In just 5 years, investment in one kind of speculation, index funds tied to commodities, has grown from $13 billion in 2003 to $260 billion this year so far. That's a big growth. In March 1999, the price of gasoline was 98 cents per gallon. Today, as we all know, it's over $4 a gallon. In the last 5 years, the price of food and energy-related commodities has increased by nearly 200%. To me, there's a connection between these numbers and the increase in commodity speculation. I mean, just these graphs will show you very briefly. This line is the average price of oil, and this line is the number of contracts for crude oil, in this case on the NYMEX for West Texas crude. So you can see that as the number of contracts has gone up, and these are speculative contracts that make the big effect, the price has gone up as well. This one over here, I almost called you Vanna White there for a moment. Sorry. I know you too well. I can get away with this. Rising commodity prices strongly related with growth in index-based commodities. So these are the index-based speculators. Look how they've gone up just in the last 2008, 2002. They were nothing back in the 90s. And look how the price has gone up. That's the dark line as well. Of course, there are other factors that have contributed to both the growth in these investments, speculative investments in commodities, and the increase in consumer prices. There is some increase in demand, but nowhere near the increase in the price that has occurred, and the weak dollar. The weak dollar has played a role in driving index speculators, particularly to commodity futures contracts as a way to hedge against inflation. But I will tell you, from all the evidence that I've seen, excessive speculation is a big part of the food and fuel price problem, and it is clear that the Commodity Futures Trading Commission is currently ill-equipped to address the problem. The administration has taken some steps to begin to deal with the problem, and many of our colleagues have proposed solutions to improve the transparency of markets, increase surveillance, add resources to the CFTC. We agree with many of those problems, including raising the margin requirements, so long as the increase in margin requirements doesn't hurt the physical traders, the people actually in the food and fuel business for which these markets were created. But Senator Collins and I are focused on strengthening the speculative position limits that were put into this law in the 30s to curb the amount of speculators can invest in a single commodity. Those limits were first authorized in 1936, 72 years ago. It's obvious that the law needs to be updated to reflect the changes in the market since then. Very briefly, let me describe the three draft proposals that we're presenting today. They range, I suppose, from the aggressive to the moderate. The first and most aggressive proposal would bar large institutional investors from investing in the commodity markets. In these drafts, we define, as a beginning discussion point, large institutional investors as those with more than $500 million in assets. It's not clear to me that large institutional investors add anything other than a significant premium to the price of food and oil commodity contracts, whereas normal investment by the physical traders, the bona fide hedgers, can provide price stabilization and market liquidity. Here's a powerful piece of testimony presented to our committee, and it goes to the index speculators. Demand for oil futures contracts generated by index speculators over the last 5 years is comparable to the increase in demand for petroleum products generated by China's economic growth over the last 5 years. So in a way, the surge of index speculators into the commodities markets has created almost another economic superpower, which is increasing demand for these oil futures contracts. Second proposal would cap the amount of overall market share in any one commodity that can be held by financial speculators. In other words, we would create an aggressive speculative position limit for each commodity. Now the limits in the 36 Act are how much any individual can have in commodities speculation. This proposal would try to, because there's so many more speculators in the market, limit how much of any one commodity could be held by speculators. This proposal would not affect the market activity of what I've called the physical traders, the bona fide hedgers like farmers, food processors, and oil producers. Third proposal would close the so-called swaps loophole, which allows large investors to end run the speculative position limits created in 1936. I mentioned that each individual, according to the 36 law, can only hold so much in any one commodity, but a loophole has developed which, when speculators buy the equivalent of futures contracts over the counter from large banks or other financial institutions, individual speculative limits would therefore apply to all investors on all exchanges, United States and foreign, as well as over-the-counter contracts. In other words, closing the speculative loophole basically puts everybody, including the big interests, under the original idea of the law, which is that no single entity can own more than a certain amount of any one commodity future contract. We are putting these draft proposals on the table today to ensure that our June 24th hearing responds to them, focuses on them. We are also going to post these proposals on the committee's website, which is www.hsgac.senate.gov, and we ask and invite public comments on our website. Bottom line, the cost of food and energy is obviously creating severe economic and physical distress for millions of working families in America and around the globe. Each trip to the gas station or grocery store puts a strain on family budgets. Higher prices have already caused rationing by some retailers in our country and hunger and violent protests elsewhere in the world. We are not, as some continue to argue, witnessing, in my opinion, the ebb and flow of natural market forces. We are instead seeing excessive market speculation at work, and that is why our government must step in with new laws to protect our economy and our consumers. As always, it's been a pleasure to work with the ranking member of our committee, Senator Collins, and I call on her at this time.
Thank you. I'm very pleased to join Senator Lieberman in focusing on an issue that has such importance to our economy and to the people of Maine. I am convinced that the high cost of energy, even more than the downturn in the housing market, is responsible for the current economic downturn. And when I look at a state like Maine, a low to moderate income state, where 80% of the homes use home heating oil to keep warm, I don't know how many Mainers are going to cope this winter. They are frantic about the cost of home heating oil. They can't figure out how they're going to afford between 800 and 1,000 gallons of home heating oil this winter. I first became aware that excessive speculation in the futures market is playing a role in the high prices when I talked to home heating oil dealers in Maine. They told me that they were not experiencing shortages such as occurred in the 1970s. Instead, they pointed to a huge influx of new money into the futures markets from pension funds, university endowments, foreign governments, and other institutional investors. It only seems logical to me that if you're pouring some $250 billion into commodities markets that previously was invested elsewhere, that it is going to have an impact on the price of oil and food commodities. This is a real problem. If you look at the correlation that Senator Lieberman has outlined, what has happened with prices does not seem to be correlated with the fundamentals of the market, with normal supply and demand. something else seems to be at work. That is not to say that the increased demand from countries like China and India is not a factor. Obviously it is. The low value of the dollar is another factor. But clearly there's something more at play. And I agree with Senator Lieberman's conclusion that excessive speculation by non-commercial traders, and that is by traders who are not purchasers nor are they producers, is playing a role in the spike in energy and food prices. Figuring out exactly what to do about this is difficult, and that's why we're putting forth these proposals on which we are seeking comment and expert advice. It is a difficult issue to confront. For example, if we do restrict institutional investors, are we ending up hurting retirees and the beneficiaries of pension plans? That's an issue that we need to get more comment on. On the other hand, I think that the testimony is very strong for increasing the authority of the Commodity Futures Trading Commission to make sure that there's a level playing field for all markets, that there are no more dark markets, that all of them are transparent. That simply makes good sense. I also agree with Senator Lieberman's proposal to close the swaps loophole, which allows for the evasion of position limits. I think that is a loophole that we must address. I also want to talk briefly about the resources for the Commodities Futures Trading Commission, because I believe that it is crystal clear that the Commission is understaffed to police effectively the commodities futures markets. In the Commission's first year of operation, which is the chart to the far left, in 1976, the total futures contract volume was 37 million contracts. By 1997, the volume had passed 500 million contracts. And last year, the volume exceeded the incredible level of 3 billion contracts. So from 1975, it was 37 million to last year, 3 billion contracts. Well, what's happened to the Commission staff level during that time? Back in 1976, the Commission actually had 60 more positions, staff positions, than it did last year. So the Commission staffing level has actually declined while the number of contracts, the volume, has exploded. Now, the chairman of the Commission has put forth a plan to add 100 staffers. He has warned that the Commission is on an unsustainable path and that additional funding is imperative. So my hope is that the bill, the Lieberman-Collins bill that we produce, will also address what I think is woefully inadequate resources for the Commission to protect the American consumer. I'm very much looking forward to our hearing next week. This is such an important issue. It's the number one domestic issue in our country today. Let me just end by telling you that last Friday I journeyed to Millinocket, Maine, a small town in northern Maine. It is on the verge of losing the largest employer, a paper mill, that employs more than 200 Mainers at that mill. The mill had been profitable until the price of oil went through the roof. This is a very concrete example of the lost jobs that are being produced because of energy prices. If we can tame the excessive speculation in the futures market, if we can ensure that the Commodities Futures Trading Commission has the resources to guard against price manipulation, it would make a big difference to businesses small and large, to farmers, to fishermen, to truck drivers, and to the people of this throughout this country.
Thank you very much. I totally agree with Senator Collins about the underfunding of the CFTC. We're going to actually, if this package passed, give them a lot more responsibilities, and it's just a fraud if we give it to them and don't give them the staff to enforce it. Be glad to try to answer questions you have now. Yes?
There have been a variety of bills that have already been offered. Senator Collins mentioned the resources issue. Senator Durbin has a bill that would at least attempt to address that issue. And also CFTC yesterday, I don't know if you guys saw, but they announced some arrangement, I think, where they would ask for more information from the ICE, Europe Futures Market, and
Yeah.
the
Intercontinental.
buy market too, right?
Right.
And, I wonder if you can comment on that and also on these other proposals and how they might shape whatever you guys
Yeah.
are doing.
Well, look, my conclusion is that the reality of these markets has gotten way beyond the Commodity Futures Trading Commission, which was supposed to be protecting us under the law from excessive speculation. And the CFTC has begun to take some steps in recent weeks to try to catch up, because this is, I think everybody is beginning to see that speculation in the commodities markets is a big part of the reason why fuel and food prices have skyrocketed. So I appreciate what they've done, but I honestly think that, based on the testimony, he was the chief economist was before us last time. He wasn't the chairman, so perhaps he was in an awkward role for him. But, they operated on a theory over there, it seemed to me, that speculation was basically part of a natural market, that it helped the market be liquid. But this has gone way beyond normal market speculation to really what we would define as excessive speculation. And it takes us back to 1936 when the Commodity Futures Trading Act was adopted. And why were these speculative position limits put in? That is saying that only that a speculator could only hold so much in the market. It's because they were worried about manipulation of the market. Well, we have now seen extraordinary, extremely painful speculation in the market in dollar amounts and with financial instruments that members of Congress in 1936 could not even have dreamed of. So, I repeat what I said in my opening statement. I don't put all the blame here, but a lot of the blame for rising gasoline prices is in these commodities markets and the speculation there. And to me, for all a lot of the answers given to the crisis are really, honestly, longer term, to break our dependence on foreign oil, to have more fuel efficiency, to drill for more oil in the U.S. To me, if you can crack this speculative market pressure on the price of gasoline and food, you can bring relief to consumers in the U.S. and around the world more quickly than anything else that's been discussed.
Could I have just
Please.
2 quick points to that? One, our goal is to produce a comprehensive bill. There are various bills that have been talked about or proposed, but we're trying to do this in a more comprehensive way by looking at everything from the budget and the resources to whether there should be an aggregate position limit placed on non-commercial speculators. So we're trying to take a more comprehensive approach. Second, I think the Commission has been extraordinarily cautious in dealing with this issue. I would even go so far as to say that the Commission has been timid in dealing with this issue. The Commission should have been, in my judgment, more aggressive in looking into this problem without prompting from Congress. The Commission should have been more aggressive in coming to Congress with the statistics and asking for additional resources before now. The Commission could have taken steps on its own to extend regulation to ICE, for example, by not issuing a no-action letter, or by issuing a no-action letter that was conditioned on reporting and transparency. The Commission could have done all of that, but has not done so. And it's only been because of Congress pushing, closing the Enron loophole, for example, holding hearings, calling upon the Commission, that we're finally seeing the Commission act. And that, to me, suggests that the best way to ensure that the Commission is more aggressive is to put language in law.
Very well said. I agree. Yes.
Two questions. First of all, is this like a menu of legislative options, like where you're just going to select one of them, or could it come out with all three of them in there?
Yeah.
And the second question was, can you release the witness list? Specifically, I was wondering if you had any pension fund.
Yeah, I know we asked some pension fund people. Did we finally get somebody to come? Are we prepared to announce who it's going to be yet?
We have a tentative acceptance from the pension fund that represents American Airlines. The investment manager for American Airlines pension fund.
Yeah. How soon do you expect to announce the full list? We got 6 witnesses, I believe. Tomorrow? Yeah, because we want to confirm everybody. But Mr. Lucan will be there. The first point, these are 3 proposals that emerge from the testimony that we've taken from the experts. And that's why we put them out there to invite responses. We're serious about them. As you can hear, Senator Collins has some questions that are quite good about the proposal to prohibit institutional investors over a certain size from dealing in commodities at all. And we'll ask that question to the witnesses next week. But I would hope in the end that we put these together in a package along with the support of more resources for the CFTC, and we put in the legislation. Look, after that, in the normal course of the Senate rules, these measures would go to the Agriculture Committee. And so I hope that we can generate action. If not, we haven't talked about this. I suppose we could look for a vehicle on the floor to introduce this as an amendment, because this is really hurting people and hurting our economy. And I think we've come up with some answers here that can really help. Yes.
What sort of receptivity have you had from Democratic leadership? They, as we've already talked about, they've offered their own sort of proposals that are slightly different from this, more investigating rather than actual controls. How is Reid, Schumer?
Yeah, I can't say that I've talked to them specifically about this at this point, although obviously I welcome their responses. I was at a discussion at one point in which committee chairs sort of talked to the leadership about what our activities are a couple of weeks ago, and I mentioned that our committee was looking into the impact of speculation in the commodity markets, and the Democratic leaders were very encouraging and urged me to go forward and let them know what we came forward with. So I think there's interest in this. I have appreciation for the other proposals made, and as I say, I probably support some of them. I believe this is the toughest set of proposals with regard to the impact of market speculation on food and fuel prices that have yet been introduced here in the Senate.
And in terms of, what would you say to the 2 arguments that say, look, if you get rid of all of this speculation, you're getting rid of liquidity for people who provide hedgers with options, and also, well, you're going to just drive these markets. That's the other criticism. You're going to drive these markets to London, to elsewhere, where you can't regulate or see them.
Right. First, I'd say that I'm going to think of your last question, and then remind me of the first, which is that look, we're trying here to take within the embrace of American law activities of American pension funds, investment banks, people who are speculating from here, no matter where they're doing it. So this is an attempt to reach markets out by the participation of people here at markets outside. Secondly, without spending a lot of time on it, I think the American exchanges and markets are the most trusted in the world, and I think you leave these markets at some peril, really. Tell me what your first one was.
Hedging. Real hedging.
Okay.
If you take out the liquidity.
Yeah. Incidentally, let me come back to the first one, which is, if we start to get into a competition with markets that are regulating less than we are on a problem that is this significant, rising gasoline and food prices, this is going to be a race to the bottom. And I think we can't afford to do that. In other words, I think we've got to set the standard. On your other question, there's a key distinction here, which we've learned, which is between speculation and excessive speculation. And, we're going to try to define that in these by what we do in these proposals. A certain amount of speculation in these markets helps the physical traders, but the speculators are now dominating the commodities markets. And the real physical traders, the commercial traders, the farmers, the fuel oil dealers are reduced to being a minority interest in these markets, and they're being hurt by these markets, as the oil dealer in Maine told Senator Collins. So, this is what we're here for, to legislate effectively, to take care of a real problem, and to be able to draw a reasonable line between speculation that's probably good for the market and then this excessive speculation, which is not only bad for the market but bad for the rest of us. You want to add anything?
Thank you all.
Thank you all very much.